Welcome to the Deep Dive. Today, we are cracking open the relationship between the UK tax system and your personal financial security toolkit.
Right.
We're talking protection, things like life insurance, income cover, and, of course, retirement planning.
Yes.
If you think about it, the UK tax rules aren't just an afterthought. They are sort of the plumbing that connects everything in your financial house.
That's a perfect analogy.
And if that plumbing is leaky or poorly structured, the whole house suffers.
It really does. I mean, taxation is never an isolated topic. Our mission today is to pull out those few critical tax interactions that determine whether a plan is just adequate or if it's truly excellent.
So we're looking for the key differentiators.
Exactly. The things that separate efficient planning from, inefficient planning, it's all in the details.
Okay, so we're diving deep into how policy structure impacts income tax, inheritance tax, IHT, and even business taxes. And we're starting with protection.
A great place to start.
It seems simple on the surface, but it hides some pretty serious tax traps that, well, you need to know about.
Let's unpack this.
Okay, first up, the fundamentals of personal protection. So, life insurance, critical illness cover, income protection.
Right.
If you, the individual, pay for a life or critical illness policy from your taxed income, the lump sum benefit is generally paid out completely tax-free.
And that's the core attraction, that tax-free element.
It is, but that simplicity on the income tax side can create immediate complexity with inheritance tax.
And this is where it gets really interesting. Here's the trap. That lump sum is meant to provide immediate cash for your family, right?
Of course.
But if the policy itself is not written into a trust, the entire payout is automatically counted as part of your estate.
And that could push the value of the estate over the IHT thresholds.
It could, yeah, increasing the tax bill. But even more immediately, it means that money is tied up. It gets stuck in the probate process, sometimes for months, even years.
Which defeats the entire purpose of having the cover in the first place.
Exactly. Writing the policy into a suitable trust is the absolute critical move here. It takes the money out of your estate for IHT purposes.
And it avoids probate.
It sidesteps probate completely, so the money gets to the beneficiaries quickly when they actually need it. A trust is often the only thing standing between an efficient payout and a delayed tax trap.
Okay, now let's switch to income protection, or IP. Its tax treatment is different because it really depends on who pays the premium.
This is a vital distinction. It all comes down to one question. Who is the payer?
Right, so if I pay the IP premiums myself.
If you pay them personally, then any benefits you receive when you're ill are paid to you tax-free. Simple.
But what if my employer pays for it? Maybe through a salary sacrifice or just as a company benefit.
Then the whole landscape can flip. If your employer pays the premiums, that cost might be treated as a benefit in kind.
A BIK.
A BIK, yes. And if that's the case, then the income payments you eventually receive when you're ill, they become taxable income.
Wow, okay, so that's a fundamental switch.
It's absolutely crucial. A policy you pay for means a tax-free benefit. An employer-paid one often means that benefit is taxable. You really have to scrutinize the setup.
And before we move to retirement, there's a clever bit of business planning here, isn't there? Relevant life policies.
Yes, RLP. It's perfect for small business owners or key employees where a full group scheme isn't suitable. The company owns it, pays for it, but the payout goes to the employee's family.
And the tax efficiency.
It's fantastic. The company's premium is usually tax deductible against corporation tax.
Okay.
And crucially, it's generally not treated as a benefit in kind for the employee, so they don't get that income tax charge. And of course, the payout is IHT free if it's in a trust.
So it's a really neat way for a company to provide a big benefit, get tax relief, and avoid the BIK charge.
It connects all those tax spheres perfectly.
Okay, let's transition now to the big picture tax engine retirement planning. If protection is a tax shield, then pensions are. Well, they're a strategic tax engine.
Oh, absolutely. They are arguably the most powerful long-term tax planning tool we have in the UK, all because of that upfront tax relief on contributions.
So how does that work for an individual?
Well, when you contribute, you get tax relief at your highest marginal rate. A basic rate taxpayer gets 20% added to their pot by the government automatically.
And higher rate taxpayers.
And they can then claim the rest back, the other 20% or 25% through their tax return. It significantly cuts their immediate tax bill.
And what's the angle for business owners here?
For For them, employer contributions are usually an allowable business expense, as long as it meets the wholly and exclusively test.
Which means?
It means the contribution is tax deductible for the business, which cuts their corporation tax bill. It is often the single most efficient way to get money out of a company and into your own pocket for retirement.
But of course, with such a powerful relief, there are limits. Advisors really have to navigate the annual allowance.
That's right, and it gets very complex for high earners because of the tapered annual allowance, the TAA.
Okay, tell us about that.
For most people, the annual allowance is substantial, but once your adjusted income hits a certain high threshold, that allowance starts to shrink or taper.
So the amount you can contribute tax efficiently gets smaller.
Drastically smaller. It can go all the way down to just a few £1,000s.
How do people accidentally fall into that trap?
It's easy to do because the calculation is complex. It's not just your salary, it's your total income plus any employer pension contributions. The taper is steep. For every £2 you're over the threshold, your allowance drops by £1. It can lead to thousands in unexpected tax charges.
But there is a way to mitigate this. Carry forward.
Carry forward is a hugely valuable tool, yes. It allows you to use any unused annual allowances from the previous 3 tax years.
So it's essential for certain life events.
Absolutely. Think of a business owner who sells their company. They have a large lump of cash they want to get into their pension efficiently. Carry forward lets them do that.
Okay, one final note on limits. The Lifetime Allowance, or LTA. It's been abolished, but I hear advisors can't just ignore it. Why is that?
That's a critical point. The penalty charge is gone, yes, but the underlying legislation still refers to it. Advisors have to be familiar with historic protections, things like fixed protection or individual protection.
The protections clients took out when the rules were different.
Exactly. If a client with one of those protections does something like makes a new contribution, they could accidentally lose that valuable protection.
And that could affect their total tax-free lump sum entitlement.
It could. You have to know the history to advise on the present.
That makes perfect sense. Okay, we've covered getting the money in. Let's talk about getting it out withdrawals and drawdown.
Right, the part everyone looks forward to. The primary benefit, of course, is the tax-free lump sum.
The pension commencement lump sum, or PCLS.
That's the one. Usually 25% of your pot, completely tax-free. The other 75% goes into your drawdown fund, and any withdrawals from that are taxed as income.
So every withdrawal decision you make has an impact on your tax for that year.
A direct impact. You have to understand how your drawdown strategy interacts with your state pension, any other income, and your tax bands.
And what about that infamous emergency tax code trap? What happens there?
That's one of the most common client headaches, and it's purely mechanical. When a pension provider processes a big one-off withdrawal, they have to use PAYE.
Pay as you earn.
Right. But HMRC's system often assumes that big withdrawal is going to be your new monthly income. So it applies an emergency tax code as if you were earning that amount every single month.
Which leads to a massive overpayment of tax initially.
A huge overpayment. You get far less cash than you were expecting. And while you can claim it back, it causes a serious cash flow issue right when you don't need one.
So the key is careful withdrawal management to avoid accidentally pushing yourself into a higher tax bracket for that year.
This is where strategic coordination really comes in. The goal is to smooth out your taxable income. An advisor can help you combine pension withdrawals with, say, taking money from non-taxable wrappers, like an ISA.
So you use the ISA to fill up your basic rate band.
And leave the tax-deferred pension money to keep growing for longer. It's about using all your tools together.
And what about defined benefit, DB pensions?
Well, DB income is taxed just like normal income. But there's less flexibility in how and when you take it compared to defined contribution, DC schemes. So it just requires careful coordination with any other pots you have.
Okay, now let's tie everything together, protection and retirement, specifically how they're treated on death.
This really highlights the core difference. With protection, the goal is always immediate cash and IHT avoidance.
Which you achieve with trusts.
As we discussed. With retirement planning, the strategy is completely dominated by your age at death.
And the magic number is 75.
It is. If you die before age 75, most DC pension death benefits can be passed on to your beneficiaries entirely tax-free. No tax whatsoever.
That is an incredibly powerful incentive to preserve pension wealth.
It's massive. But if death occurs after age 75, the rules flip. The money is still outside the estate for IHT, but your beneficiaries will pay income tax on it at their marginal rate.
So that pre-75 versus post-75 line is one of the biggest planning opportunities in the system.
It really is. It shapes every decision about whether you should spend on your pension now or preserve that capital in the tax-advantaged wrapper for your family.
So it's about seeing the whole picture.
Successful planning is about coordinating all your tax wrappers, pensions, ISAs, bonds, everything. It's making sure the tax strategy aligns perfectly with your risk tolerance, your security goals, and your wishes for your estate.
So if we distill our key takeaways today, for protection, it's all about who pays the premium, personal versus employer. And for retirement, the major planning opportunity hinges on when death occurs, pre-75 versus post-75.
Exactly. And that leads to a final provocative thought for you to consider. Given how powerful that planning opportunity is around the age of 75, how might knowing that date change your perspective on taking income from your pension now, versus maybe drawing down from other less tax-efficient assets simply to preserve that pension capital for the next generation?
Something critical to mull over as you align your own strategies with those key tax thresholds. That's all the time we have for this deep dive.